So, hi, my name is Adrian. My government name is Adrian. I go by Adcv. I'm a co-founder at Steakhouse Financial. And I wanted to talk a bit about how to build a high-performance LRT, as if I knew how to build a high-performance LRT. So Steakhouse Financial is an advisory business. We're a boutique consulting firm. We work with major DAOs, including Lido. And, I'll apologize if I offend any sensitivities. I'm personally a stake.eth bull poster, and I wanted to share some of our experiences building LRTs with Mellow and Symbiotic, using wstETH as a collateral. And the objectives of this talk are quite simple. We are quite simple thinkers. We generally have quite low IQs, and we try to think through things in very simple terms. So the three questions that we ask ourselves are, sort of, what is the basic expectation from the user of an LRT? What is the ideal structure that this LRT could look like? And what type of networks are we looking for as LRT curators? And a lot of this is going to be framed through a sort of economic or financial lens, so less perhaps technical, but we try to dive into those areas where we believe it's relevant for explaining the structure. So on the financial point, we're approaching this from a purely investment framework mindset. We have this total return model. My colleague Sonia developed this, anchored on sort of fundamental investing practices, where you can break down the total return exposure to, for example, Ethereum, as a combination of the price return in dollars, as well as the work yield, what we call the work yield. And this is the return that you get for trusting a network. And if you hold just ETH, it has a dilutive effect on that return, but that may well be a risk consideration that you want to take. And restaking essentially adds on new components of this work yield. And so in our framework for sources of return and variability of return, we have this sort of two-dimensional matrix where we go from left to right, from native ETH all the way out to LRTs. And on the vertical axis, we classify the types of return, quote-unquote return, in regards to their variability and potentially their risk. So you have, the consensus layer rewards, the execution layer rewards, all stacking on top of each other. And when you get into restaking, you start to involve the sort of restaking rewards either in, and we would think of them as sort of non-volatile and volatile. And then on top, whatever additional rewards you get from restaking middleware. Used to be only EigenLayer, now there are many more. As well as potentially LRT points and so forth. But we would tend to sort of stay in the non-dotted line area, which we find more fundamentally interesting. So what is the user expectation? Like, again, from a very fundamental perspective, a user that opts into restaking very likely probably expects at the very least the native staking rate. And the native staking rate is already economically quite complicated. There's, from the gross staking APR, which is kind of a virtual number, because in order to achieve it, you need to either delegate it, and in this diagram we show an example where a commission is paid to a delegated staker, but also for a solo staker, they will incur hardware costs or operational costs that will drag on this return. And one consideration that we identified is that restaking middleware that imposes additional gas costs on the native staking yield will perhaps face more difficulties in attracting the users who, at the very least, expect that sort of basic rewards rate. And then in pink, we have the little, whatever the restaking yield will be in the future. And so for staked.eth, we believe that it's a very good proxy for what the basic native reward kind of looks like. And the reason that we're comfortable sort of bull posting about it is because it actually has, in our view, a very measurable and very positive effect on the decentralization of Ethereum. The same goes for Rocket Pool, for what it's worth. To the extent that they delegate to more and more node operators in a diversified way, and as long as governance doesn't control them, they have a net positive. We believe that they have a net positive effect on Ethereum security. So what issues remain to clarify before we can build a product that offers access to restaking rewards for users who are looking for that additional risk and reward? There are sort of three main areas. The first one is the duration mismatch, which I don't think in this era of points farming, we've really fully explored what that means. So from the perspective of a network or an AVS that's looking for restaked capital, they'll typically expect some level of security commitment for a fixed period of time. you would imagine that they would expect it for at least a period of time, until they get bootstrapped, until they gain adoption, and until they can, so that they can guarantee a minimum level of security for their users. However, users who provide restaking capital are likely to expect far more liquidity. So there's a duration mismatch that needs to be balanced already. The native token rewards need to be reconciled with the user preference. Some people may value having ABS tokens, but we believe that most restakers will probably denominate in ETH or at the very least in USDC or similar. And then slashing conditions obviously need to be clarified before any of this can take place realistically within a risk management framework. And we believe that staked helps address many of these actually, because staked as collateral can offer users more liquidity and help mitigate that sort of duration mismatch and that alignment of expectations. And then it's with sort of within the construction of an LRT, and this is not exclusive to staked ETH, but the aggregation of multiple networks can potentially help diversify the source of rewards if they come in native tokens. And then obviously we need to clarify the slashing conditions so that proper risk management can actually take place. For discussing what the ideal structure of an LRT is, we're doing the simple thing and sort of drawing on our original work that we do and that we did and continue doing for Maker, where we look at basic asset liability management models and frameworks for doing things such as modeling liability outflows. So in the case of a stablecoin, this is a very obvious area of focus where you can look at, and tokenized stablecoins provide you with a unique window that bank deposits don't have into seeing how quickly liabilities flow in and out of the system. And you can, using that, basically make a proxy for how much liquidity you can make available for your users. So on the graph, we show an extract from a June dashboard that we made for Maker, where we show the amount of mismatch at different levels of liquidity, and the advantage is that this sort of updates live. And so, why are we interested in LRTs? The short answer is that we are one of the curators on Mellow. Mellow is a modular LRT system that's built on Symbiotic that allows people to commit ERC20 tokens and additional forms of capital to restaking. And the barriers to entry are coming down, so access to curation will become, in our view, more of a differentiator rather than sort of plays on infrastructure or how the LRT token is built necessarily. And you would expect this from a vibrant restaking ecosystem, that your ability to risk manage and to curate will likely be actually the differentiator for why users choose you over an alternative. And so from a balance sheet perspective, in what we're thinking is that wrapped staked ETH is actually a very useful form of restaking collateral. From a balance sheet perspective, on the blue and red rectangles, you have stake LRT modeled as the liability token. And on the blue, you have sort of the assets. And in our framework, in our model, what we're aiming to achieve is to have a fully wrapped staked ETH-backed LRT that reserves a certain amount of liquidity and a liquidity buffer to allow for quick withdrawals, the size of which we could modulate with time, depending on the level of outflows, and which restakes to 1 or 2 networks, depending on the match with our fundamental framework. At the moment, this is not technically possible on Mellow yet, and frankly, all of the LRTs on Mellow at the moment are identical. They just mostly hold wrapped staked ETH, except for like some more exotic forms of collateral. But in the future, this is definitely something that we would want to see. And so what types of networks are we looking for? So in our framing, in our sort of mental model of what restaking is essentially a buy versus build for a cryptographically secure network. On the left-hand side, you have this sort of build considerations where you can end up with a sovereign network, with a fully secure and decentralized and autonomous network when it's completed. But it comes with the trade-offs of having to spend an enormous amount of capital up front to attract users and having to bootstrap a network of validators to make sure that it's secure enough. And so restaking is obviously a very interesting technological innovation because it will hopefully allow the emergence of an ecosystem of networks that can achieve or inherit the security of Ethereum, like one of the most secure networks possible. The trade-offs for the restaking network is that they now face a new sort of slot in the capital structure, so they have to make sure that they can meet these restaking fee obligations. And the early stage unit economics may be very challenging. So if you're a new network, you may find it difficult to pay in non-volatile currencies, and you may still have to rely on paying in the native token. So for networks that we're looking for very fundamentally sound businesses with sound business models. These are things that are simple, that we can understand. You know, pre-confirmations are one example of it. It may not necessarily be relevant for Symbiotic, but it's an illustration of the type of additional restake network that can provide some value to the base layer. And in the final slide, I wanted to show our framework for our network curation model. It's very simple. We're very low IQ. We can only understand a certain number of things. We have our return on trust model, where we have the price, work, and loss given default. And we have two basic considerations. The network has to have a sustainable business model, it has to have a clear use case, and a profitable source of restaking fees. And the second one is that we would frankly rather not have shitcoins. We would rather have, no offense, sorry, for AVSs, but we would prefer, more politely put, we would prefer non-volatile reward tokens. This may end up meaning that we restake to 1 or 0 networks, and that's fine as well. And in order to evaluate what the sustainability of a network looks like, we propose the restaking operating affordability ratio, modeled on the debt service coverage ratio from TradFi, to break down the cash earnings of an AVS in a non-volatile basis in terms of its profitability, its efficiency, and its TVL. And this is how we would sort of structurally evaluate the suitability of a network for its ability to provide restaking fees on an ongoing basis. And I echo a lot of the sort of comments that Ismail was mentioning, that the sustainability of these business models is fundamental, and it really is sort of the rate limiter to growth. Like the restaking marketplace has clearly shown that it's capable of raising an enormous amount of capital, but there's still the question of where this capital is going to go. And then the restaking affordability ratio for us will also be a useful measure for how what we think of oversecured or undersecured a network is. So the more, you don't necessarily want your network to be oversecured. You don't want a network to pay more than it has to for restaking. But if you're building a secure network, you similarly don't want it to be undersecured and not have enough capital available for slashing in the event of a malicious actor validating it. I have 8 minutes left, but I've actually gone through all of my slides, so I hope that wasn't too fast. Please clap. Thank you. I guess we have 8 questions. I don't know if anyone has any, 8 minutes. I don't know if anyone has any questions. Yeah. No, yeah, we're not going to operate. Like, we're advisory. We only know how to do like Excel spreadsheets and June dashboards. So that's why Mellow was so helpful. Like, we only ventured into like the curation space with Morpho, and it was an experiment for us, but we've ended up building off-chain bots and infrastructure that help run these vaults, which made it very easy to do it for Mellow as well. So even if Mellow is simple, it still requires some off-chain maintenance. But we don't have any validators. We might run 1 or 2 like nodes in the future, but we expect to rely on professional node operators. We'll delegate to as many as we can. And yeah, I mean, Mellow just makes it easy, and that's sort of the reason. Mellow makes it easy, and Mellow accepts wrapped staked ETH, which were the 2 conditions that made it possible for us to use. Yeah, it's interesting because Mellow already has like, more than 10 LRTs. The barriers are so low. I think Renzo is on there. Some professional node operators are actually on there. I think Chorus One has a vault. Luga Nodes has another. It'll obviously make it possible for lots and lots of vaults to emerge. I'm not super certain that the liquidity of the LRT itself is just a theory. Obviously, EtherFi is very liquid. Renzo is very liquid, as tokens themselves. I don't know if that's super valuable in the context of restaking, given the expectation that you're sort of locking up a little bit more capital. So in the same way that staked ETH has liquidity because it's easier than a withdrawal, for example, and people value using it as collateral. I don't know that the collateral features of an LRT are necessarily so suitable for example, leverage staking. Like at the moment, it's fine because very few of these LRTs are actually doing any restaking. But the moment that you introduce some heterogeneity, it's going to be really difficult to figure out how to liquidate, for example. Like if you have an LRT with 10 AVSs and there's a liquidation event, like how on earth, especially if they have like the native token, it introduces so many complications. So I'm not super bullish on the idea that these LRTs necessarily need liquidity themselves. For us, the liquidity is within the buffer. So in the earlier, oh, well, it's gone. In the earlier diagram, we had a liquidity buffer with the idea that it's within the Mellow vault. So it's not restaked at all. This feature does not exist in Mellow, but I keep hounding them to make it because it's something that I think will provide the form of liquidity that users will actually want, which is sort of on-call withdrawability, but not necessarily secondary market.